Sunday, November 13th, 2016, Monaco 64, home of alternative economics and contrarian views. I'd like to talk about the bond market today and yields, and I'll focus on the 10-year note, Treasury, U.S. Treasury. First of all, I'd like to talk about the overall market reaction to the election. I think it's still very uncertain. Right after the, overnight on November 9th, when it looked like Trump was ahead and was going to win, the Dow dropped 5%, gold went up 5%, Treasury yields actually dropped to like a 173. And then all of a sudden things have turned around, and the main meme on Wall Street and the mainstream media, the people who have been manipulating the perception for investors and traders for 15, 20 years. The main meme is that with President Trump now, there's going to be reflation, the economy is going to do great, and interest rates will go up. And that's negative for precious metals. All that, there's going to be loads of government spending and deficit spending and get the economy going. So on a dime, everything has changed, perception. And there's a note saying that most of you probably know, Rome was not built in one day. So that's the way the markets react. They've priced in all the things they expect Trump to do, in less than, in about 3-4 days in terms of the markets. And you just have people, shifting assets all around, creating volatility, triggering stops. So I still think it's not wise to be in this market trying to trade it. Just watch from the stands, so to speak, as I said before. Nothing has changed fundamentally for the economy. Trump still needs to be inaugurated on the 20th. He still needs to, he still have the Electoral College that's going to vote, I think, in December. So nothing is really certain yet, in my opinion. And I think the market is, as usual, overreacting and doing things like, discounting things right away. Well, and apart from that, fundamentally nothing has changed. The U.S. still has 20 trillion in debt, national debt. The U.S. still has over 200 trillion in unfunded liabilities, which is Medicare, Medicaid, Social Security. The U.S. banking system still has, hundreds of trillions in notional derivative exposure. So let's talk about the bond market. So just to let you know, on Friday, it was a bond market holiday. So actually the U.S. Treasuries did not trade, the cash Treasuries. The futures did trade. They were down a bit, about 1/3 of a point. But I'm taking the levels from Thursday because officially, the cash did not trade in the U.S. It was a Veterans Day. So it's a bond government holiday. So U.S. Treasuries are not traded. So I'm just looking here at the 10-year yield, and to me, it looks like we've formed a double bottom in the 10-year yield. Let's have a look here at this chart. This chart is going back to 2012. We had a low in 2012, just below 150 in the yield there. You can see 145.67. And then we had a low this summer in July that was around 135, so about 10 basis points lower. But you can see it looks like we formed a double bottom. It's not the exact level, but it looking at the chart, it is a double bottom. And as you can see, since the summer, since July, we've gone from 135 to 215 on Thursday. 2.15. So that's a pretty big move there. You can see there's kind of a spike higher on the chart above that 2% level. So personally, I think very important to keep an eye on this 10-year yield. It's the benchmark yield for for all assets, in my opinion, all financial assets. Stock markets are priced off interest rates, corporate bonds, derivatives, everything. So yeah, this is the short-term chart. I think it's very important to keep an eye on this 10-year yield. You see how quickly we've moved. On election night, when the Dow was down 5%, the 10-year yield got down to 173. And now we're at 215. So that's like 43 basis points in a matter of days. So it's very possible that we could go, test 2.5%, which seems to be the next resistance important level, and it's a round number. Bond markets look at round numbers like that, like 2%, 2.25, 2.5, 2.75, and then the really big important number is that is the 3% level, which is actually the high on this chart, which was reached in the end of 2013, beginning of 2014, 3%. So I think 3% is in the cards, and if we break above that, then I'd start to worry about interest rates being, out of control, because there's a difference between interest rates or yields creeping higher, and there's a difference between interest rates and yields spiking higher. That's a loss of control, and right now it looks a bit like that. So, and now I'd like to look at a chart from a long-term chart of the 10-year Treasury yield, because we got people on Wall Street now saying that higher yields are going to be great for the stock market, and that higher interest rates and reflation is bearish for gold. We even had Stanley Druckenmiller, who sold his gold position because he said we're going to have a reflation, and he's more positive. But one thing I would say about Mr. Druckenmiller, I know his hedge fund has done well over the years, but he was the guy as well who said that John Kasich, the governor of Ohio, who ran in the Republican primaries for the candidacy of the Republican Party, Stanley Druckenmiller said that John Kasich was the only guy in the Republican Party who could beat Hillary Clinton. So I'm not saying that Mr. Druckenmiller is wrong, maybe about getting out of gold, but all I'm saying, he's not always right. He was completely wrong on Trump being able to beat Hillary Clinton. So let's have a look at this 10-year Treasury bond yield. And the reason I want to look at that is that Wall Street now and the mainstream financial press is saying that, oh yeah, higher yields are bad for gold and it's good for the stock market. So look at this 10-year Treasury yield is from 1962 to present. And you can see that from 1962 to around 1981, that 10-year yield was going up, which means a bear market in bonds. Again, I want to reiterate that higher yields in bonds are not like a positive thing, they're a negative thing in that when yields of bonds or treasury notes go up, the prices drop. So if you invest in a 10-year note and the yield starts moving up in the first 2-3 years, and you need to get out of that 10-year note, and you pay par for it, and if it's now down at 70, you've lost 30% of your capital. Of course, if you wait 10 years, you get 100 back, but inflation will probably have, destroyed the value of your principal. So as you can see there, from the early 60s to the early 80s, there was a bear market in bonds. We went from around 4% yield to almost 16%. So if you'd bought a 30-year bond, a 10-year bond, for example, in 1970, and it matured in 1980, you would have gotten the 100% back, but it would be worth a lot less in terms of purchasing power. And then you can see from 1981 to the present, it's been a one-way street downward. You can see the double bottom there from 2012 to 2016. It looks like a double bottom, and that 3% top there in 2013-14, end of the year there. So that's the Treasury, the long-term 10-year Treasury note yield. So yeah, it has been in a bull market, and it's corresponded to the bull market in financial assets like stocks and bonds. You know, the Dow was around 800 in 1980, and now we're almost 19,000, and it's corresponded with the yields going down. So I find it amazing that Wall Street is now saying the fact that there's going to be reflation and bond yields are going to go higher, that it's positive for stocks, just seems a bit puzzling. Unless we get hyperinflation, then, you know, stocks could go up, but the value of the dollar will be trashed, like in the Weimar Republic. So now, just to show you that I'm not trying to, like, you know, to show you that I have the facts here, I'm bringing a chart, historical chart, and it's actually adjusted for CPI, which is a government measure. But anyway, here's a chart at S&P 500, you know, in the last, I think, 90 years or so. And you can see from 1960, around 1960, you know, to 1980, from the mid-60s to 1980, the S&P 500 went from around 700 to around, you know, 300 CPI adjusted. So that's how well the stock market did in the period of a bear market in bonds. It actually went down in real terms, CPI adjusted. So all the talk on Wall Street that and the financial press that higher inflation and rising yields are going to be great for stocks, I don't know where they get that. So now I want to move to something that's very important in my opinion. Oh, actually, let's also have a look here just to make this point clear. At the gold market, this is a chart from the LBMA, and it's a price of gold from 1968 to 1980, when we had the bear market in bonds. So we had rising yields, and we had the bear market in stocks. Look what gold did. It went from $35 an ounce to around $850 or $887.50, which was the intraday high. So there you have it. You know, all the talk that it's negative for gold, don't buy into it. So now I want to move actually back to the bond market and how it's the most important thing to look at. Keep an eye on that 10-year yield. And I'll put the link below in the description of where you can get the 10-year yield live prices. And why do I say it's important to look at it? Because we've all heard about all the derivatives, you know, bubble, and the fact that we have over 1 quadrillion of nominal derivative contract out there, and how it was the failure of Lehman that triggered the daisy chain of derivative failures, and why the U.S. government and the Fed and the Bank of England had to bail everyone out. I know they've changed the accounting for derivatives, and now we're only supposed to have about 700 trillion, but that's still huge. And the other thing I like to point out with interest rates, the 10-year yield in the bond market, is that the majority of you know, derivatives are interest rate derivatives. So when you get volatility, you know, all over the place in the bond market, that's not conducive to stability in the derivatives market. So here's a chart, and this is just for the U.S. banks of, you know, it says derivative contracts by type, insured U.S. Commercial Banks and Savings Association. By the way, this is from the Office of Controller of the Currency, which is a part of the U.S. Treasury. So here you can see that interest rates derivatives, second quarter of 2016, worth 140 $794 trillion. And then you get foreign exchange derivatives, which are worth 35 trillion, equities 2.6 trillion, commodities 1.3 trillion, and credit derivatives, which are also related to interest rates, 6.8 trillion. So there you have it. That's how big, the bulk of all the derivatives are based on interest rates and credit. So that's why interest rate derivatives are so important. It could bring down the whole house of cards. So that's why we need to keep an eye on the 10-year yield and how quickly it moves. So to end the video, let's have a look at, and I've done this video about this before. Let's have a look at the banks that have the biggest derivative position. So we got Citigroup. This is from the latest data, 30th of June, 2016, and again it's from the Office of Controller of the Currency. So Citigroup has got 53.5 trillion of derivatives contracts. JP Morgan 52.7 trillion. Goldman Sachs almost 52 trillion. Bank of America 42. Morgan Stanley 29 trillion. And HSBC North America, 10.5 trillion. And HSBC, I mean, that's a British bank. So the interesting thing about this is that look at Goldman Sachs. Their total assets are 896 billion, but they've got 52 trillion in derivatives. Quite an amazing, sight to behold. So yeah, to conclude the video, sit tight. If you have investments in the stock market, just consider them as investments. It's like, you own a house, you live in it. You're not going to keep looking at the price unless you're highly leveraged. Yeah, that's the key word. Don't leverage yourself. It's silly. And the other point, keep an eye on the 10-year yield and the bond market. It's very important. It's the base of all the financial system. So if you enjoyed this video, please give me a thumbs up, share it, subscribe to my channel if you haven't yet. If you think I add value and you want to sponsor the channel and help, there's links in the description below for donations. I accept Bitcoin, BitGold, PayPal, and Patreon. Take care and have a good rest of the weekend. Bye.